Welcome to another episode of You from the Ranch. My name is Gregg Pacitti, and I am here with my Chief Investment Officer, best buddy, Brad Tremitiere. Hello, Brad.
Hello, Greg. Thanks for having me.
Good to have you, sir. So we are in the month of September now, and August was a pretty mild month. Yeah,
good month.
You called it. I have to give you some props that you thought it was going to be at least a decent
we weren't
month.
too excited. I'd have to say that the S&P and NASDAQ did pretty well, but it was interesting to see that how much the small cap space had improved. I mean, it was up almost 7% for the month. So anytime we have the small caps leading, it's going to be very good for the overall market.
And what's from the previous low of the year? I mean, it's been a pretty remarkable recovery.
It's been a great move, 25% off the lows.
That's
one
huge.
of the best we've seen in a long time. But it's been associated with a number of positive, indicators that we follow. We spoke last month about breadth, the number of stocks on the New York Stock Exchange that are advancing minus the decliners. Added to the previous day, we continue to see breadth make new all-time highs. So there's no negative divergences that we're seeing. It's broadening out to a bit. We started to see some of the bigger name tech stocks maybe pause here, but overall we're starting to see more participation. And the one thing is our daily money flow indicators that we keep have been 70 to 80% positive all the way up. So the move has been excellent, but there's a lot of support underneath it that leads us to believe that if we do get a pullback, it will be short in nature, get rehabilitated relatively quickly, and there's better days ahead.
Yeah. Well, everybody seems to be so concerned about tariffs and inflation, and so far the tariffs, from our view, seem to be working out pretty good, bringing some revenue for the government, which is nice, having foreign countries contribute to paying down our debt. What's your thoughts on it? Like, is it something to worry about? I know they're going through there's a big fight of whether Trump was able to or had the legal ability to enact those tariffs without Congress.
Well, last week his appeal to the ruling by the that tariffs could not be used through the Economic Emergency Act, got ruled against. So they've appealed it again now to the Supreme Court, which will probably take the case next month and rule on it sometime in the first quarter of next year. I don't understand why there's a lot of people getting in the way. Sure, things have got to get done correctly, but we're going to look back in 12 months and realize that the amount of money we've taken in by tariffs is going to be basically equal to what we've seen in corporate income tax over the same period of time. So it's a huge benefit. It's allowed us to allow them to push through the big, beautiful bill, which gives tax cuts to everybody. So it's a benefit that's going to be helping paying some of the changes that have taken place. But also it helps on the monthly treasury budget to make our bottom line look better because of the massive deficits that we've been running basically since COVID.
Is there a chance, like, if the Supreme Court didn't agree that he had the ability to make these decisions, is there a chance that we'd have to pay that money back?
Well, I mean, they could come in and force it to be paid back, but it's a sticky point for the Supreme Court, but I'd have to say there's a better pathway than one would expect because of the number of judges that actually dissented in the vote, as well as, the one judge that brought the initial dissent up was actually an Obama appointed judge. That's pretty well respected with the Supreme Court. So the appeal with the Supreme Court gives Trump enough time to use basically the Trade Act of 1974 to use different sections of that act to put the tariffs in place, in a much more, I guess you could say, legal way, but also a much more solid way that, there's not going to be any major issues like what we're seeing now with fighting in court about it.
Okay.
So it will get done. It's just a matter of how.
Because the tax bill is a lot dependent on that. So, and the tax bill, I mean, there's going to be a ton of tax savings for people.
And there may be some inflation that we see through this, but it's, we've got probably 2-3 quarters to make it through before, whatever we're going to see in the tariff response, starts to go away.
Yeah.
So, hate to say it's transitory, but we expect the tariff inflation to be transitory.
Now
Famous last words.
Yeah. Now we had a big Fed speech at Jackson Hole, not a meeting, but a speech, and that seemed to encourage investors, like walking away, like, "Hey, finally, Powell is starting to lighten up a little bit and be a little bit more dovish." What was your takeaway from that?
Well, I mean, it's a pretty large turn from what was the stance by the Fed, even a few short weeks ago. And that all goes back to the release of the July non-farm payroll report, which, was pretty horrible from a revision standpoint. So, the problem that I see is the way that the Fed interprets the non-farm payroll data and the way that data is actually comprised is a little archaic. It has a lot of question marks that it leaves open. So, what is the real data when it comes to jobs? Is the numbers that we have seen the last couple of years, are those really the true numbers? Because they're so revised in such a massive way.
How much was the last revision?
Significant. It's still positive, but it's been that way for 2 years now. So the survey results that the Bureau of Labor Statistics uses doesn't work very well anymore.
Where are they getting that from? It's like
don't even get me down that rabbit hole. But we're starting to see what real jobs look like. We're starting to see natural born citizens getting the jobs versus foreign born employees, which basically comprised most of the job growth the last 4 or 5 years. The main thing is that, what has that data really been as far as jobs goes over the last 1.5, 2 years, as we've been calling for the Fed to cut rates. Now, when they see jobs get revised this much and, a real slowdown from what we're finally starting to see, maybe that data being incorrect has, caused some problems because the Fed has stayed too high or too tight for too long.
They tend to do that anyways.
Yeah, as we talked about last time. So
I did read that continuous claims reached 1.97 million, which is the highest level since November 2021. So like people are struggling getting jobs. You've got real estate that's barely moving. I mean, there's certainly issues out there.
But if you look at the job openings versus the employment data, you look at the JOLTS, the employment market's really balanced right now. The labor force is relatively balanced. Doesn't mean it's not going to get worse, but right now it's relatively balanced.
Back to normal.
I don't think anything's going back to normal, but there's a lot working through it. But at least for now, it appears to be balanced. And I mean, we probably could average 60 to 70,000 job gains per month to be able to keep that unemployment rate around 4.2, 4.3%. Mm-hmm. So it just is going to be interesting to see what the data starts to come out at, as they're trying to do a better job to be more concise on the monthly payroll numbers, because that's important, because the unemployment number is what the Fed bases half their mandate off of.
And so after that Fed speech, there was like an important technical indicator.
Oh, yeah. I mean, the move by Powell to become dovish for the first time, opened up the floodgates on that Friday. It was August 22nd. And basically what we saw was a 90% plus day where 90% of the issues on the New York Stock Exchange traded. We're advancing issues. We've only had that happen from our data maybe 28 times since the last 50 plus years. It's extremely bullish. Now, early on, you do get an overbought position. So it may take a week, 2 weeks, 3 weeks, 4 weeks, a month, 2 months to work out, being that overbought. But as you go further out, the returns are excellent, and they're almost always positive. I mean, 1 year from the signal, the S&P average is like a 22% return. There's only been 2 of those years that have been negative. The signal was in '07, which a year later we're in the depths of the financial crisis. And then
so that one did not work.
Yeah,
out.
And then in 1974.
So it's not absolute, but we go on probabilities, and so we like to see these things that line up and historically have led to higher prices, but you just never know. But it certainly helps you with your mindset of how you want to position your portfolio.
And again, when it comes to these indicators or breadth or money flow, we just want to see things stay in line. We want price and breadth or whatever we're looking at to work together. What we would look for before we would want to start getting concerned about the market is divergence, where, the underlying support of the market continues to get weaker, yet the price goes higher. That
hasn't been the case.
The clearest case was the tech bubble, because breadth had been weakening substantially for a year, and price just kept going and going and going, and then it had to get back in line. So, we have more data we can share on that, but until we see a longer term divergence where price just keeps going, but the indicators don't support it, we're not going to be too concerned. The market still can pull back. It can go through a rough period, but it's going to be shallow, and it should rehabilitate itself.
So let's talk about a rough period potential, because we are now in September, which is historically the worst month of the year for investing, but there is some.
Again, going back 50 plus years, I mean, September is the only month that's negative, down like 0.9% on average. August is the second worst, but it's still positive. And it's just a factor of, consumers spending less now that, summer's over. You do have fiscal years ending for mutual fund companies at the end of September. So there's a lot of, selling to clean up portfolios. You do start getting into, some early tax loss harvesting for individual investors. And for some reason, there's been a large number of increases in treasury issuance in September, which, does pull money out of the market. But usually when you're strong going in to August, we mentioned this last month, but it gets even better when you're strong. Let's say June, July, and August, the return in September is usually decent. I wouldn't say it's much better than the average. It's flat to up, 0.1%. I think it's already happened about 11 times. But again, moving forward, that strength that we've seen the last few months usually keeps going. We can see a rough patch here where the market has some issues. The only time that, we ended up the rest of the year where it was negative was 2018, and we were dealing with a bunch of Fed issues and then interest rates and quantitative tightening back then, that led to a sell-off the second half of the fourth quarter. But overall, again, strong. Even we can throw May in there too. Strong May, strong July, June, July, and then August. Usually September is a much better return than what you normally would expect.
I think the market's surprising a lot of people, even us. I mean, we went into this year neutral, where we've been really aggressive, overweight, kind of waiting to get more defensive, but luckily we didn't, and we're just sticking with that neutral.
I think we can make a case for an increase in, I think we could look at global growth starting to reaccelerate, and I think there's a period here of, 1, 2, maybe 3 quarters that we've got to work through some stuff, but there's a chance for us to start to reaccelerate after we get through some of these comps that we got to go through. And, we're seeing some better lifting out of the international markets. Most of them have done well for the first time in many years. I would say that maybe our feelings on Europe have become a little bit more neutral, because unlike here, Europe has been cutting interest rates, and now they're kind of at a good balance point as far as yields and rates go. So we could see some more activity coming our way just from the simple fact that we're going to start going into rate cutting cycle. But there's just a lot of different things. I mean, look at the airlines, look at the cruise lines. I mean, they're all doing pretty well. And I don't think we're going to have a horrible economy if the cruise line stocks are doing very well. The Chinese market's starting to do well, which is good for the global economy just from a consumption standpoint. So we still have stuff to work through, but there's a lot of interesting things out there that are happening. And unless our indicators start to get worse and deteriorate, we'd have to believe that any weakness that we see is, something that's short term that we'll be able to pull.
There's a lot to worry about, but there's also a lot to be optimistic about. I mean, certainly, of course, AI is nothing new, but I mean, that is something real that I feel like is just getting implemented more and more. 30-year, mortgage rates are at a
huge.
10-month low.
That's rolling over.
6.56% was the latest as of today. If that could get down to 6%, I think you start seeing a boost in real estate. A lot of refinancing is starting to go on. So.
And in response, we've seen the housing stocks do a lot better.
Yeah, and if this tax cut gets through, I mean, people are going to have a lot more money in their wallets, and if the tariffs pay for that, and it doesn't really cause a lot of inflation, I think that's really the game plan that has a real possibility to have us really end the year strong.
And that's the one issue concerning the legality of tariffs and some of the fighting that will go on is, for some reason, if the tariffs that a certain number of tariffs that have been added can't be changed, that's fine. They're not the reciprocal tariffs that weren't implemented underneath the Emergency Powers Act are fine. The problem is, though, if it gets to be too big of a fight and we can't use tariffs anymore as an effective funding tool, there's a large hole in the government's balance sheet. And the issue there is that deficit could increase bond issuance, which could increase bond vigilantes to come out. And that's probably the biggest concern we'd have, is a runaway bond market that, just keeps pricing yields higher and higher and higher because we have to keep issuing more,
right.
Which this issuance problem that we have really wasn't a big issue until about 2 years ago when we raised the debt ceiling, and all of a sudden we're up 100 billion extra in issuance on average every single month.
Well, at least they're talking about it. I mean, I think we need those checks and balances. So hopefully the tariffs work out and we start paying down our debt and keeping us out of trouble. And it's just like any household, we just can't let that debt run away forever. So.
And as far as the market goes, it's good to get this rotation that we're seeing. I mean, NVIDIA, Microsoft, Broadcom, they can't always lead. They've been doing a lot of the heavy lifting. But what's nice is, while they may be pausing right now, Apple has stepped up and has, been extremely strong of late. Google had a massive breakout, which is excellent. So
Apple's still down for the year.
Yeah, but it's the strength is there, and I think they'll be pushing to new highs pretty soon. Okay. The move in Google yesterday is excellent. So, while NVIDIA and Microsoft can't carry an Amazon, well, Amazon looks good too as well. Can't carry everything. They keep the rotation really helps keep the market moving in the right direction. So,
yep. All right. Well, so we're staying positive. Probably. Potential for a small pullback in September, but the market's been very resilient. So any of that, maybe you start thinking about deploying some more cash for expectation of a fourth quarter rally. So we shall see, and stay tuned. We'll talk to you next month. Thanks for watching. God bless.